So, welcome to another episode of Finance Village. I'm your host, Sheldon Bro, and I've got my co host, Seun Adeyemi. And today we have a heavy hitter. He may not appreciate how heavy of a hitter that he is, but to many of us that are very, very passionate about the financial industry and that never had any Michael Jordans or Spider-Mans to look up to growing up, he is a hero for us in the industry. And I would say, like Michael Kitce, he's a litmus test for those that take financial advisory and planning very seriously. You should be following him on LinkedIn for a lot of great posts and staying up on the industry. Today, we're going to explore the legal and ethical challenges that financial advisors face when advice goes wrong. And we're going to discuss the impact of kind of misleading advice on clients, the legal risks that those advisors will encounter, and some practical ways to protect and build client trust. Joining us is Harold Geller, a well-respected advocate in the realm of financial services law. And Harold has spent decades championing the rights of consumers and holding both financial professionals and institutions, and maybe on occasion regulators, who knows, a little bit accountable. And with experience in financial consumer advocacy and a lot of deep insights into the systemic issues, he's going to guide us through this kind of complex topic. But I don't really picture a lot of people as a child, Harold, forgive me, dreaming up the idea of going to fight the financial consumer advocacy battle. So I would love to for you to give us your origin story, if you will, on how you decided to focus on this niche and what motivated you to kind of go down this direct path.
Well, thank you very much. It's a pleasure to be with you. So my story is sort of mundane on one level and unusual at another. And that is, growing up at the dinner table, securities was a topic of conversation. Yes, I grew up in a strange family. In the early years, my father, my sister, and my brother-in-law were all involved in issuing of securities through leading law firms in Canada. As I went into university years, I did some work, really because of contact of my father's, at a leading brokerage in Canada, running around watching people get really excited about their commissions. At about that stage, my father also was appointed as vice chair and then acting chair of the Ontario Securities Commissions and the International Organization of Securities Commissions. So it was sort of in my blood. But coming back to me, as I went through law school, there was a bit of a social advocacy bent to my education, and it's certainly what I was attracted to. I found that criminal law was not my area, as some of the people just couldn't stand defending, but they were entitled to defense. So I migrated over somewhat happenstance into the area of financial advice. Essentially, my story on that is I was a member of a social service club. One of the members came up to me and said, "Harold, you're doing a lot of small claims court stuff." I was a junior lawyer. I have a claim. And it was a agent who had sold an impaired annuity. The woman had died. There was a guaranteed period. And the children had elected for the commuted value. What the heck is that? And she had paid already to her lawyers more than if she had lost all the lawsuits.
Wow.
So it was a problem, but it was a practical problem. In the end, the major problem was nobody understood what the product was other than the agent. So everybody was hot and up and bothered about what had gone wrong, when in fact, the children, the beneficiaries, had elected for the commuted value and got the equivalent of time value over money. All very complex. But how do you simplify it? And that was my job. I went around interviewing people in the industry to understand what was involved. I recognized I didn't know, even though at that point I had passed the course in order to sell securities and had studied some insurance. I still didn't know what I didn't know. So I interviewed. From that, I got asked to speak on behalf of some errors and omissions insurers, add some education, and advisors. I was being trained to really represent advisors because no one was doing it at the time. The institutions were appointing their lawyers, and often the advisor and the institution, the dealer or the insurer, had different interests. From that, I started getting referrals, but I didn't get the agents or advisors I expected. I got their clients, people that they were giving second opinions to, who they thought had been misserved by the former advisors. Lo and behold, it was a niche. It was a niche that not many were doing. And as a result, I got involved in helping people through representing them in these claims and had to study and study. And to this day, I spend about an hour a day reading industry information because I'm always studying. How does that convert over to the advocacy side? Well, as you're probably well aware, consumers in Canada are not really represented before the regulators who make the rules. The regulatory committees are almost exclusively made up of either industry participants, former regulators, or academics. Financial advisors and Canadians are relegated to get-out committees which are consulted at the end of the chain of regulatory process, not at the beginning. And my job, in large part, on those committees that I got appointed to at the Ontario Securities Commission's Investor Advisory Panel, the IROC, as it was then, Arbitration Working Group to try and bring life to that, FISRA's Consumer Advisory Panels, OBSE's Consumer and Investor Advisory Council. All of those, my job was largely to just tell what was going on in the trenches, what we saw day in, day out in our client file work. And what was it we were seeing? We were seeing mistakes in large part, incented by compensation grids. And then even though supervisors were often aware of evidence of wrongdoing that could harm the clients, they were repeatedly burying the information. And if there was a complaint, despite the complaint handling rule, saying, nothing here to see, move along, just like in Star Wars. And we know where that ends up. So I was bringing that to the regulators so they could make better informed inquiries, enforcement proceedings, and hopefully regulation. That's how I got in the business.
Well, thank you. That's like so many things came to mind as you shared your story. So quickly before I pass it off to Sean here, first of all, bless you for taking the massive weight of not only having to learn all of the things that you have to dance around in law, which is plenty, keep you working an incredible amount of hours, but it sounds like you then also have to take that labor of now product knowledge and complex financial things. And those complex financial things come in many forms, kind of related to the first question Sean will ask, because even as somebody that has 20 years in finance almost, has worked in the big banks, has worked in the independent side, has worked very cohesively and collaboratively more than most with all the different kinds of professionals for really holistic advice, I still have my head spinning on some of the examples that Sean is going to give you. And I still am always just trying to figure out, well, what's the reality of some of these different kinds of things, complex products are available. So having to dive deep into those worlds, I admire it, but it also I probably won't sleep tonight thinking about the fact that you have to go so deep into the product knowledge in order to apply the law. And it's interesting that you kind of started that niche thinking, I guess, you were going to be serving advisors, and it kind of ended up, but really the more heroic one, you get to be more like a Spider-Man.
It's where it's where it took me. But let me just tag that to something I'm sure we'll talk about here.
Yeah.
Is the KYP, know your product obligation of advisors, now in insurance as well, is a massive challenge for advisors. And it's certainly been one of my challenges, is I consider myself a serial voyeur. As a case comes to me, I have to dive into the product and learn about it and the strategy. For financial advisors who have to cover such a wide waterfront, it is a very significant challenge and obligation.
And I think just to piggyback off that, I think that's one of the reasons why advisors with some firms just generally tend to focus on a specific product, and that's all they sell. And there's a pro and con to that. Obviously, the pro is that you have deep knowledge and expertise on that product, and so you're in a better position to serve somebody that someone who just has a surface level knowledge. But I see the con also as when everything is a nail, then the tool becomes a hammer. And so you're not really looking out in the best interest of your client. You're just looking at, this is the product I know. And so this is the product that I'm going to use to serve this client in every situation. So there's pros and cons to that. And even for me as a planner and as an advisor, it's one of the challenges to understand, here's what's available on the market. Here is what I think would better serve my client, but not just simply offering that product on a very superficial level, but truly understanding the ins and outs of the product. Going back to your point on know your product before you offer it to a client. And so if I'm going to go down that rabbit trail of know your product, there's so many, like, what would you say is the most complaints you're seeing among the vast products available in the marketplace? We're only going to touch on a few because I'm sure there's a lot of them.
So it's essentially, it's exactly where you're going. It's the complex products and the ones with no visibility or next to no visibility. So we see a lot of private equity sold regardless of suitability. We know about the conflicted commission, but let's come to your product issue here. Is that the ability of an advisor to know what is truly on offer, to evaluate the suitability components of a private equity is somewhat far-fetched, somewhat mythical. There's not enough information provided. Largely what you're relying upon is sales brochure and packaging for sales by the manufacturer, the dealer putting together the deal. Sometimes you get flyers if you're at a larger dealer. You get flyers about, oh, this is what we're selling this week. This is great. Not comparative and not in depth. It does not meet your KYP obligations. So the mis-selling on that is a major concern. Also, because of the high commissions, perhaps because of a belief system that if my dealers bring it to market, it must be the best thing. There's over-representation of private equities in many people's portfolios. Look, you can have a moonshot, a lottery ticket in almost any portfolio. More than that is a challenge. The other product that we see a lot of is universal life, sold on an ART basis or sold in abandon. So there's no continuing service of the actual holdings, but ULART is an incredibly sophisticated, complex, and risky product. You need the money to take out the insurance component. Otherwise, in later years, after 7 or 8 years, it's a failing product, and you can be guaranteed for it to get problems. Let me give you an example of that. Client comes to me, actually, their daughters come to me because they can't figure out what's going on. Their mother and father, many years before, over 20 years before, had bought and sold a ULART by their advisor, who was also their securities advisor. He knew they had a bunch of money. Now, the diversification was a good idea. The diversification plan failed. Why? Because she got a demand. Policy had run out of money, had already paid $6 million in, ran out of money, and this 89-year-old gets a demand for $75,000 per month to keep the policy in force. In effect, in later years, her risk of death was so high that the underwriting for that year reflected that risk. Obviously, that was not maintainable. And when we go back through the records, there was never a disclosure that future funds would be required. And about 12 years after the policy was in place, there were warnings on every illustration. This policy is running out of money.
which comes to the
wasn't
abandonment
shown to the
aspect you're
client.
talking about.
Yeah.
Okay. And the advisor would write and say, don't worry. If we run into problems, we've got the fund. We'll take care of it. Not saying this could be a reason why your policy fails. Get the millions of dollars still in it out while you can. So it's complex products, which the average consumer cannot understand. So it's in really close to a fiduciary relationship, complete reliance on somebody who has special knowledge, expertise, and training. And it's a blinding conflict of interest for both the private equity and the ULART because the commissions or compensation paid are so high as compared to a suitable portfolio of what we used to call blue chip investments, right? So there was an alternative that could have performed, as we know, much better over the 10, 20, 30 years of investment. That's what we see a lot of, complex products.
Well, I do want to disclose to you that we are going to coin some of your phrases. So one of our things that we'll be stealing with you, and we'll give you the credit: mistakes consented by compensation grids. I really like that one. And the blitz rewards are a big problem of it, to getting these like random kind of, we have this new thing, sell this product and get your name in a draw to go to Vegas and all this other nonsense. I've seen that since the call center days, and that when I started at the big bank world, and that has always been a problem. I would just totally ignore them and tell my managers I'll be just selling what the client needs, as though they're my grandmother thanks.
Well, if you meet somebody at a cocktail party, chances are you're going to like them. And that's how a lot of sales presentations start, isn't it?
Yes. Yes.
Okay. It's not about the quality. It's I can read somebody. I like this guy. That's not due diligence.
The UL point is one I come across almost so regularly. It's just nauseating. Just working with another advisor right now, and we gave him all the points of why a UL ART is terrible. And he goes back to the advisor, and the advisor says, no, they're lying to you. This is the best product for you. And I'm just like, okay, like, how do you hold advisors accountable?
You can't really do that demonizing both ways. And think about some of those complex products that are popular for that, Harold. 3 of them would be infinite banking, the secret of the rich, as they say. The seg funds, which kind of has that battle back and forth, which you've done some recent work on, which we'll get onto a little bit later in depth. And then the infamous JP versus JP, IPP versus PPP. And I know, I just JP'd you, Jason. If you've heard of that one, that's been going on for a long time, and my head spins on it. There's sophisticated people on both sides of that conversation where I'm like, I don't even know what to believe here. And
I've seen these IPPs or PPPs, whatever you want to call them, brand them something. I've also seen emails where the person putting together the PPP is recommending and uses the term on internal communications, his partner, who's the IA. Okay? So far, I've only seen them fail. They could work, but they are a big risk for the investment advisor because it's a big risk for the clients. Most of those plans involve people who don't have much experience with investing. And all of a sudden, they've got a big investment, which is in the hands of the advisor and has to perform, or the whole plan falls apart with great expense. It's a great sales concept, but it's going to be for the extremely few, and often it fails. Are you the advisor? If you're the advisor, do you want to insure that risk? Because in effect, that's what you're doing, because your client's unlikely to understand what you got them into, at least at the time they got in. They may find out after talking to me.
So I'm thinking here, because this profession offers a lot of glitz and glamour when you're looking in as a new advisor. You can
comes with the out of the box BMW, the sunglasses, the hair gel, right?
I drive a 10-year-old car.
the trips and the trips and you name it, the plaques and all of that. But for an advisor looking in, how does one balance the reward or the potential reward versus the risk that it provides? And I want to speak specifically to think of advisors who work with a bank or who work with a captive dealer that have these sales quotas or have this incentives as part of their packages. How does an advisor
product mix of stuff that,
exactly, how does an advisor in that kind of environment balance the demands of their employer and putting the needs of the client first? Like, what are you seeing?
Or can they not, and they just have to run out and go independent?
Look, you've asked a really good question and a really difficult question. So bank clients, I think, are entitled to access to good financial planning. You notice that term, good financial planning. It starts with, you've got to spend less than you make. Okay? Start with the basics, not what the banks do. But what everybody should be doing is, are you paying for your daily expense? Then, do you have a plan to pay off your debt now? Because that's a guaranteed return on your investment. Okay? You stop paying the interest, it's a guaranteed return. Then it's about your ramp towards your goals. Because until you have paid off or have a good plan for paying off your debt, your future goals, you're borrowing from one hand to pay for the other. And you're paying interest on it at bank rates. Not great. So let's go back to your question. Once the planning has been done, assuming that, then I have real concerns about proprietary only silos. As of about 5 years ago, the publications out of the Canadian Securities Administrators were saying that they were highly concerned about proprietary products and the conflict of interest embedded in selling them. When the banks then dealers went to closed shelves only containing their own products and associated products, in effect, those are often second-rate products. So the advisor, doing their best, having done a plan, is limited in what they can do. I believe they cannot meet their obligation to do what is in the client's best interest. CIRO has it clear, that's the regulator, has
intrinsically because of where they're at. You're saying in the proprietary products, it's not possible to meet what they would want to meet.
Sometimes a proprietary product might be a good solution, might be one of the best solutions, but it's rarely always. Banks' offerings, we see them routinely where they're ranked on the quartiles. Okay? They're rarely the top quartile. So that really limits. On the other hand, an advisor should be helping those clients within their bounds. Okay. And I'll leave that aside for a moment. Independence offers some real opportunities. Opportunities for your client, opportunities for yourself. You're giving up that secure paycheck with bonuses. Secure paycheck, which is awfully nice for a lot of people. But if you're at all entrepreneurial, and most investment advisors claim that they are, then obviously being at a big company is not entrepreneurial. It's contra. Okay?
That's right.
Whereas going out into the independent workforce. From the independent workforce, you have some great opportunities for your own income, great opportunities for earning that income off of assisting clients, great opportunities for the world is your oyster of options for helping your client. These are all very good. And you also have an opportunity in both situations to really be very important, a member of your community. Member of your community because you've got these specialized skills. You've got these specialized training. You've got this experience. People are looking up to you. You're very important. So the opportunities are to include being an important, valued leader of our community, helping out individuals with one of their most important decisions in their life, after their marriage, after having kids, and financially maybe more important than their houses they buy. So it's really, really key. What are the risks? Well, inevitably it comes back to risks to your client and related risks to yourself. The more that you're pushed into selling product that isn't in the best interest of your client, the more likely clients are going to have reason to question your efforts, reason to question what your priorities were. Independents, they have some risks to their reputation as well, without doubt. But I want to put this in early in our discussion, which is, as a professional, you and I as a lawyer, you as a financial advisor, to some degree, are guarantors of the process by which we will go through. We should never be guarantors of the result. And as guarantors of the process, we must be compliant. We must do what is in our client's best interest. We must put ourselves in a position where that's not limited, in my opinion. I think it's very important, and I think it's why our regulators are asleep at the switch right now. They're allowing these siloed sale of proprietary products, knowing that they are risking Canadians' futures.
And, and that's what I find frustrating, because unfortunately, it also feels like the Canadian market is quite asleep, and I'm talking about the consumer market. Like when you look at the advice coming from the bank channel versus the independent channel, it's so skewed towards the banking channel. Unlike our southern neighbors, where there is, even though the banks still own a big share of it, there is a bigger and bigger share on the independent space. On the Canadian side, it's the flip. The bigger share is with the banks and the incumbents. And I wonder if the reason why the regulators are slow to move against that is are there financial incentives that are they afraid to rock the boat? Like, I don't understand why proprietary products, and the idea that even recently, I think I heard of
Canadian Bankers Association has a lot of pull, and I think we need to have a lot more. I mean, there are agencies like FCAC, like Financial Consumer Agency of Canada, that I'm sure Harold has done some work with, but like the Canadian Bankers Association, and not just with that, with innovation, even in the financial technology, getting clients access to their own data within the banks and things like this. I mean, there's
open banking.
There's so many things that you've touched on, Harold, that
Well, just think about it. The Canadian consumer, they walk into a bank, they have an existing relationship with the bank. They're beholden to the bank. Most of us have some sort of loan. Okay, and then you're getting cross-selling. You're getting cross-sold, and I don't care what is the veneer on it, into both their securities arms for sale of their own product and into insurance, their associated insurance arms. That's a huge impact on why most Canadians end up going to those institutions. It's access to the consumer. The issue that you've also brought up, and I think it's very important, is who are the regulators? Most regulators come from either industry or firms that service industry. It's a closed-knit crew. And when you're a member of a club, you listen to your club members. So access by industry to regulators, policymakers, is at a point that if Canadians understood, they would be shocked. Go to some of the Christmas cocktail parties or the lunch and learns where regulators are trotted in and introduced to a friendly crowd. Okay, they're not being paid under the table or anything like that for these services. It's part of what is, I guess, expected. Now, put it on the consumer side. You'd think that they would get equal contact. There is no like opportunities for consumers. They can go to a yearly open house, some type of speech by the head, which is completely choreographed other than a very limited question and answer period, which is largely taken up by industry insiders. So there is no equality. They're out of touch. And they maintain this. Look at who are on the boards of the regulators. Look at who's on the committees. The boards do go out and get what they call independent directors. People who can be very well-intentioned and very knowledgeable in their areas. But what they aren't knowledgeable about is what's going on in the trenches of industry sales to Canadian consumers.
The academics.
They're leaders on literacy. They're on elder care. They're They're wonderful people, but what they can't do is challenge the processes put in place because they're oversight board. The challenges the processes put in place, and make sure that the regulators are listening to Canadians.
The irony of it is those that are supposed to be regulating conflict of interest have their own implicit conflict of interest.
Yes. I said that my father was the vice chair or the chair of the Securities Commission. He always believed that if you gave people the opportunity, they would always put forward their best face. They would do what was right. It's naive. I think he was a wonderful man. He was naive on that basis. And if all you've got access to is your own like people on the other side of the table that used to be on the same side of the table when you were represented industry too, of course you've got a different view than consumer who's gone to a financial advisor and found out that their inheritance, their retirement, their savings are gone or have not grown. Well, there's been hundreds of thousands of dollars of commissions earned. I have clients who have inherited $8 million, paid the advisor over $300,000 in 3 years, and during the last 4 years, which has been a booming economy, did not move forward, did not gain any additional savings without looking at any withdrawals they did. That would be their own responsibility. Who won on that one? Why are the regulators not thinking about those Canadians? Those are real stories.
So it almost feels like there has to be a big case that makes the headlines for anything to change. And that's the sad part of it. Like somebody has to be struck bad.
You see those happen, and it still doesn't. There could be 10 huge articles about any big bank tomorrow, but the way that we love monopolies in Canada, I've been with the CBIC or the TD since I was 5 years old, and we don't trust something, and we see that unless we see that big logo that we recognize. Even if we see that big logo that we recognize in the news 5 years in a row for high pressure sales tactics, it still doesn't click, and we think that that's something separate from us, that only other people got treated
only
that
happens
way.
To other people. I think about the Fortress Real and syndicated mortgage stuff years ago, which almost seems to be making a comeback. And I'm like, is it that Canadians are not reading the news and are still falling prey to this beautiful brochures or magazines that guarantee you're going to get this return? Going back to private equity, like Fortress Real was for years was like the dominating person to do this. And I know clients personally who lost hundreds of thousands of dollars.
You remember Walton? Yeah, absolutely. And it is an interesting question. I don't have the answers to it, but I look at the UK, Australia, and the US coming out of 2007, 2008. They made fundamental changes. Consumer protection through regulation and enforcement is so far superior in those three other countries than in Canada. What happened? Why do we keep appointing as chairs of our regulators industry insiders as opposed to people capable of coming in fresh with the skills necessary to head a commission? I mean, it's easy to appoint somebody,
I wonder if it's because we haven't had Canada, for the most part, we haven't had financial crisis on the magnitude that they've had. Like US.
We had REX, we had Nortel. Sean, it's an interesting debate what the difference is. At some point, you're right. There will be something so big that politicians can't ignore it. Because in the end, it's politicians who make the decisions on who to appoint. And we also know that financial advisors can have a big impact on this, because financial advisors tend to be politically involved, tend to have the ears of MPPs and MPs. They have access because they've earned that access. Why aren't they standing up for changes.
Well,
Perhaps
I'm gonna comment on that a little bit philosophically, because I believe this is a big problem that we have in many different fields, very much so in sciences and in finance, is the prestige versus like you have a noble path that you can be this big person that accomplished a lot for your industry peers, that made a lot of money, and you can be a person that has the prestige of wanting to do things right. Like if you think of even the biggest science project in the world, CERN, everybody, people in the science world often want to get those accolades and get the things, but we also have to not create a black hole that kills us all. So let's do things responsibly. And in that same way, that prestige of wanting to keep your name amongst all those peers, but you have to decide at some point, who do you want to be the hero for? Your industry peers, or the industry, or the people that ultimately are going to be affected on the day-to-day
Who we
basis.
serve.
Who do we ultimately serve?
And I put earlier about the community, your value in the community. Financial advisors really are more important to most consumers than most professionals that deal with. Admittedly, their doctor when they're ill is more important. Their lawyer when they buy real estate or have a right of will is occasionally more important. Their accountant might be more important. But really, how do you get from planning, a new job and planning for your future through retirement? It's the expertise of financial advisors and planners that carry you through that. That's why it's so important to our community. And we're taught in our community that find experts, rely upon their advice, follow it. Okay? And that's, again, a fiduciary relationship. In Canada, we have been very afraid to take on the responsibility of being fiduciaries. Financial advisors really play that role for most Canadians who have a financial advisor.
Or should play that role.
What it is.
Should play that role, but often don't.
Should.
And that's the word. And looking forward, and as negative and as frustrating as it is for those of us who really, really want to do the best for our clients, I think going back to one thing you mentioned before is the idea of knowing your product. I think it behooves planners and advisors. I like the idea of specialty because it gives you a depth of knowledge on product, but along with that specialty should come collaboration.
Yes. What you said, I agree 100%, Sean. For years, when I did education of financial advisors, one of my first slides was what I called PAN, Professional Advisory Network. I don't care what you call it. I can't cover all of the waterfronts, even in securities law, let alone in law itself. I work with other professionals. I'm not the best at writing a statement of claim. That's not my best skill, even though I've written hundreds of them. So what do? I make sure that I work with somebody with extremely good skills in that. Why won't financial advisors do the same things? And some do. You work in a group. You work in a group not only of other financial advisors who offer similar services, but also the professionals around the industry, which are very important. Accountants, lawyers. Sometimes it's just family coaches, depending on the dynamics.
Mm-hmm.
Have these in your Rolodex, share. And one of the things I've certainly learned as an entrepreneurial lawyer is givers get. The advantages of professional advisory networks are not only lessening your own liability and giving better services to your clients, but it's also that between all of you, you will be able to provide more quality products and services to your clients. The whole will grow.
I think we ought to take a page.
A quick insert here, Sean, for shout out for our sponsor, Pocket Finance, was this technology trying to bridge all of those professionals into one place and a modern experience for clients. And you're kind of highlighting that there's at least two ceilings, two things that contribute to you possibly having a ceiling in the quality of your advice. One, perhaps where you're planted, whether it's captive, big bank, independent,
solo advisor,
will give you a certain ceiling of where, yes, you can be the person. And I was the person at the I feel like I treated every person that I talked to when I was at the big banks like my grandmother. I got really strong numbers, but I got that via trust. And we want to obviously be able to streamline trust through some way, shape, or form in finance, preferably through warm referrals of professionals or other consumers that have had great experiences for an extended period of time with someone. But that ceiling can come in where you're planted or in your silos. So how many other people do you have in that realm? Because you can be giving the best imaginable advice that anyone in your silo would agree with. But then when you include now an accountant and a tax lawyer and a this and a that, now it starts to evolve a little bit. So there's, some really interesting ceilings with what even when our best intentions that we're able to offer sometimes.
I agree. And it's something which the time is now for building these communities together, particularly with the technologies now available. We can share information. All has to be with clients' knowledge and consent, but we can provide better services. That's the modern day. That's the advantage.
I think the industry needs to take a page from the law profession, right? Just like you have your real estate lawyer, you have your family lawyer, you have your divorce lawyer, you have all lawyers comes in all stripes and forms. And it's impossible for one lawyer to be able to fill all those shoes. And I think in the same vein for planners, it's impossible for us to be competent enough in every product out there in terms of how we serve our client, because some of these products are so complex, but they do have a space in the marketplace to serve the right type of client. The question is, are you the advisor that can give the best to that client for that product? And how do you identify advisors who are complementary in the same industry, just like there's the divorce lawyer and the family lawyer? How can we work together as advisors to make sure that we're best serving our clients? We ought to take a page from the law profession.
Sean, I agree, and I thank you for that. But I also want to say that, to some degree, your projects here and what we see online nowadays are some great opportunities to have interchanges with other advisors and develop those communities. I think of my own LinkedIn postings and those who comment on the LinkedIn postings, yes, and who I then see posting on their own very interesting discussions. You're able to get information about the principles which the other advisors apply. There are areas where they have better knowledge because these are in discussion groups of different formats now. These are great opportunities. I also am a big believer in study groups. I've talked at many of them, and I think that sharing everything from personal issues to business issues, and most importantly, to the services and products you can offer to your clients in study groups, is an opportunity to bat ideas around for individual clients, groups of clients, classes of clients. Always a learning opportunity. These are great things that your profession has done very well at pursuing, although I get the sense that's a bit seen as yesterday's model, not today's model. I sure hope that I'm wrong on that.
Well, I think that old model will remain, and that's another good reason to follow you, is you can be involved in those conversations in the comment section, even just as somebody that's kind of reading through it. Even if you're not contributing, you're still going to be able to learn a lot. One of the things that Sean and I want to create in tandem with this Finance Village podcast is an online community that we're preparing, that we're going to be launching a website where people can join a waiting list. And maybe even someday it could look something like being able to have, and I know that there's a lot of politics within, the comment section in the financial advisory space goes crazy on LinkedIn sometimes. And think about something like a peer review where you want to submit something within a forum that's private, that's anonymized, that doesn't have client name and company or anything attached to it, but you're able to say, I want to do the right thing. I don't have those peers in an ecosystem yet. I'd like to kind of submit this for peer review and commentary. This is the scenario. This is what I'm looking to do and why. And being able to have that kind of, people just throw in their tidbits. I think that could create some very interesting conversation as well.
Well, let me just put a plug in this for an older model that has a great database that can be searched. Lawrence Geller, disclosure, my brother, but a leading financial advisor in the disability insurance space, put together for advisorsonly.com. If you're an advisor, just send them an email. You're welcome to join the listserv. It's not very active these days, but the history is very valuable. And I'm hoping that's a dated format of interchange. I'm really excited about your project that you're undertaking. I saw that as of today, it's not yet live, but I can assure you that I went to look because I was interested in the opportunity to learn.
And that's
I'm very interested about how the
for all of
conversations
us.
in your Thanksgiving look at the table now with the different type of people you're saying. Sorry, Sean. Sorry, Sean. Go ahead.
No. But that ought to be the mentality for all of us, is just that curiosity to learn and to understand and to collaborate. Harold, honestly, I feel like we could go on and on. This conversation has been so enlightening, and I'm so grateful for the role that you play as an advocate for consumers. And I'm looking forward to having you as part of this project that we're building, of this community, where we can elevate this profession and really begin to pull the wools off of Canadians to see, like, there is a better model. There are advisors who are looking to serve you and put your best interests. And this is what that could look like. We're looking to the models in the US. We're looking to the models in the UK, in Australia. They're far ahead of us. We have our work cut out for us, but I think we have some really great people who have the same mind.
I also think it's going to be a great resource for those consumers who are sophisticated enough in their own lives, not in this area, to be able to engage, find the time, find that resource, intellectual resource of being willing to engage and learn. This will be a repository of self-learning. So it helps all of our communities, the financial advisors communities, those of us who work with the financial advisors, as well as the end person, the consumer.
Well, one of the things I am hoping to do with, some of those conversations that happen on Finance Village, because Pocket Finance, who sponsors us, is a platform where all of these people will collaborate, but there will be an education hub. And I'd like to see more collaborative education rather than just one person standing there talking about their situation. It could be more of a conversation, debate casework in front of clients a little bit, and show them that willingness to collaborate rather than that typical standoffish. I don't know if you're familiar with the standoffish nature that we sometimes have in certain industries, but do give us maybe a quick peek on what are some obvious yellow or red flags clients need to search for an advisor. Hopefully they can find one through a trusted referral network, through a Pocket Finance or some type of thing that exists that is doing some level of vetting, rather than being left to the lottery that is Google when you want to take your finances seriously. But what are maybe some red flags that you come to notice over time, or that you could share?
Okay, so what turns me off is taking an advisor that takes a client out once a year for a fancy Christmas lunch or a cocktail party, drives up in an expensive car and flashes stuff. It's not about the flashiness. It's about the process. And that's what I urge consumers to look for. So first of all, it starts with plain language. If they're talking legalese or financial jargon at you, you're not talking the same language. You're not communicating. It's a problem the advisor has to be able to explain in a way that you can understand. Number one. Number two, go back to the plan. The financial advisor should be gathering data and double checking it. How much is your house worth? I'll have an idea. Where's your address? Let me see what it sells for around there. Why? Because people get numbers wrong. How much is your income? Oh, it's about this much. Send me your T4. Okay. Cross-reference. So that gathering of information. Then a plan, again, first to make sure that you've got plus dollars on every month or over a period of time, a reasonable period of time, 6 months, whatever it is. And you're paying down debt, you got your plan on that, and that your saving is in keeping with your risks. All of us have risks. We have risk if we're married, of separation. We have risks if we have family or children who are might need our needs. Where's your pocket? That if you need quick money to help out, where does it come from? Then it comes about, what is your risk tolerance? Don't simply, if any advisor asks you, what's your risk tolerance, and moves on, oh, average. Oh, got to make some money.
It's always one of
It's
those
not,
3 or 4 simple ones,
yeah,
eh?
whatever the heck that is. There are
A
quality
medium.
risk tolerance questionnaires. Rarely are they the ones used by the dealers, but Morningstar has a great one. It's empirically based. It's been rolled out over, I think it's hundreds of thousands of clients and tested. It's fit for purpose. Is your advisor using quality tools? And then when they're making recommendations, are they telling you how they get paid and what they get paid? One of the big kickers is the coming in is total cost reporting. That should be done at the beginning of the process, because sometimes certain products pay way better. And if they tell you you're not paying me, the product's paying you, that's a lie.
Red flag.
It's a lie by omission, because there's only one payor. So if you get that sort of sales pitch, run, because it's dishonest fundamentally. Okay? What you want to know is there a conflict of interest? You don't understand how it all works. But are you looking out for your interest, Mr. Advisor, or you're looking out for mine? Paying a ridiculous amount for a financial advisor, unless you've got a ridiculous amount of money, is rarely a good result. On the other hand, paying for a financial plan or exercise is often a good use of money, even though it may have to be money out of your pocket to do so. Come back to the basics is what I say to the clients. And I urge, keep records. Keep detailed records, because it may be, if anything goes wrong, may be the only way you can explain what you were told, what you knew, what you instructed, and why it's not your fault that things went wrong. Because when things go wrong, inevitably people, the advisors, and more often the dealers, point a finger back at you and say, you should have known better.
Well,
you didn't
those,
need
like,
a financial advisor. In every direction. You should have known better. No, I went to a financial advisor because I didn't.
Well, that's a big, communication is a big conversation right now. There's been almost $400 million in fines in off-channel messaging. You know, you've got phone calls, which thankfully there's great technologies like Open Phone that I know that Sean uses, so that you're getting a good record of everything. Sometimes you're trying to avoid clients sending you a text or WhatsApp, and they, email goes into this kind of congested email, and so thankfully I think things are going to be more centralized over time, and I know No Pocket Finance is doing things like that. And you made a really great point on the intake of any experience, and the one that I kind of refer back to always as a renovation person. I've had a couple different times where I've dealt with renovation people. Sometimes a guy will come in, and imagine if he just asks you, like what you said with that kind of 3 or 4 basic bullets, what's your risk, whatever. And half the time I've answered that, I'm taking a guess as to what mine is, because the questionnaire wasn't good enough for me to help me self-determine what I am. So I'm taking my best guess and a half ignorance. Imagine if somebody comes in and will say, well, what do you think the plumbing should look like? Well, what's your kind of like, and you don't know anything about plumbing. That's all that you're asking you. So intake is everything. Because if somebody comes in with a clipboard and asks me a bunch of intelligent questions and we have a good conversation, versus somebody coming in talking jargon, vague. I don't really know what they're saying, a vague question about what I think and kind of whatever. Intake gives me a profound judgment of any product, process, professional, and whatever else. So that's that. I think that was a really all of the points you made very important, but that intake is where that's that starting process, and it makes it very obvious. And some advisors sometimes won't even talk to you unless you fill in all of the things. I do like to see a little bit of a human touch there to kind of, get me started in a conversation. Some advisors will take the thing of, well, if you're not willing to fill out this 5-page form first, then, I'm not really have time to talk to you. I think that there's some balance that can be.
That's a business call. I care more, are they gathering the information? And is it in a way which you can work with? If you can't communicate, and this is your example, Sheldon, if they're not communicating with the client, in a way that the client can participate, then they're just doing checking a box. They're not actually advising. They're not actually doing their job, in my opinion.
And I do want to just quickly show some love out to Preet Banjari, formerly a financial planner and advisor, and now he kind of has a whole bunch of things, some technology and advisor training. But I was so inspired that I went to this man's website, and he has a section that he has labeled conflicts of interest. Really cleanly laid out there for you. Like I've never seen that anywhere before with any politician.
And he's become a leader in good communications in this whole niche and doing yeoman service. So thank you for pointing him out.
Yeah, and I will say that there's a balance in that simplicity, because I have made the mistake personally of trying to, because I became very passionate about the concept of full and fair disclosure when I was at the bank, when I saw that they had it in the code of conduct as though it was this really important thing, but then we would receive emails that would be like, don't tell them unless they ask. And I'm like, well, they're never going to ask that. Like, anyways, is kind of me now taking it upon myself to go into over disclosure with clients to the point where their eyes glaze over. So finding that simple of trying to get it to them in a simple way, allow them to ask the questions. And it's no simple path.
It is no. And I will tell you that every new client I bring on has multiple discussions with me about my conflict of interest, because I'm earning money either by selling my time or by contingency risk. Okay. It's like a commission equivalent. And either way has conflicts of interest. So why don't I just say it? And so I do. And I wonder why all lawyers aren't saying it. So it's not just financial advice where this is a time for change, but it certainly is financial advice. Let's be clear about where our conflicts are and how we are addressing them, partially by, in plain language, explaining it to the client. Generally, clients will be understanding of conflicts that are not disabling, so not the extreme ones. Generally, they'll be understanding. As long as it's fair fees, fair compensation, then the compensation issue is not likely to be the barrier to working with the client. But doing that, advising without disclosing it, what type of relationship is that? Well, it's not one of trust.
So you mentioned being involved in some discussions about regulatory changes. Do you mind sharing your role in these reforms and like the impact that's having on the reforms?
So I don't really know what my impact is. I'm concerned at this stage that I'm seen more of as a maverick, and everybody's heard what I've had to say. There are very, very few consumer advocates in Canada who are independent, although most dealers, when they're writing submissions, claim to be looking out for the consumer. Not likely, but appreciate the verbiage. So I've worked on committees and seen some changes. Two good examples, which I don't claim to have had a huge influence on, but sure, I'm happy with the outcomes, is client-focused reforms in securities, which have not really moved forward under the new leadership of the Ontario Securities Commission, but were fairly fundamental changes. I'm also not seeing them implemented in ground level, at the advisors level by dealers. Client-focused reforms essentially are saying that there are clear responsibilities on the advisor and the dealer. They must perform them in the securities world, and providing more prescriptive elements of those duties. They were always the duties. They were duties in the 80s. Just they were denied when it came to litigation or regulatory enforcement that they apply. Industry was all well and good to support them when selling to consumers, but not when there was an issue. What we have seen is a real change in insurance led by the Financial Services Regulatory Agency, which is Ontario's insurance regulator for life insurance. That was a result of some groundbreaking reviews by the Auditor General's report, then by a three-person wise person committee, who essentially said the emperor wears no clothes. The old model of fiscal was doing nothing for consumers and was very good for industry because it didn't do anything. Okay, so sales worked. FSRA has really broken the egg and tried to make an omelet. They have looked at principle-based regulation, which is great to fill in, to limit the number of holes. They're now more and more doing two things, some prescriptive. So on the areas where people are saying, your general principle of being fair to consumers, avoiding conflicts, we always have done it. FSRA is beginning to say, no, these are the elements. For example, the SEG fund is a perfect example. They're also looking at things like the sale of universal life through multi-level marketers. The problems they saw with multi-level marketers, these pyramid schemes for sales, are mostly true of all MGAs in Canada. Managing general agencies, for those of us who are consumers, it's intermediaries who really control the
insurance sales.
Insurers. They're really beginning to look at those and saying, you have duties, you must do them. The concept of uber fides, utmost good faith insurance contracts, which has never been part of actual legal decisions, but has always been a foundational principle of insurance. FSRA is now saying, do it now. And so I've been on some of the committees, but I can't say that I'm at all responsible for them. I'm very pleased with these evolutions, these natural steps. They're slow in coming, but they're important for tomorrow's future consumer, less important for those who were sold bags of snakes in the past.
I look forward to the day where multi-level marketing, it's a bane of what I really dislike. I don't believe multi-level marketing and financial services should mix. That's personally because if I'm dealing with some kind of product, so whatever it is, that's fine. It's not a big deal, but you're dealing with people's finances. And then you got these hierarchies of people hiring, recruiting this, recruiting that, who have no knowledge of A from B and how that is so destructive to client finances. So the multi-level marketing, I look forward to the day where those companies, I almost want to name them, but I'm trying to keep it civil.
Well, there's almost a general nature and culture that they create, because there is a right way to build a team, build a business, do whatever, and everything has that. I appreciate the fact, and I've been complaining about MLMs for a while on enough of our podcast myself personally, but I will say that I'm glad that you also mentioned Harold, because I have had a lot of conversations across this country with, the leaders of tons and tons of AGAs, MGAs, insurers, and some of the MLM MGAs. And, at plenty of the ones that are not MLM, there's a lack of oversight of things that sometimes are being not challenged on what they're being sold.
Well, I've done a lot of litigation in the life insurance sector, and all insurers deny that Ontario Regulation 347/07, which is 04, which is the agent's regulation, but in it says that any insurer who has more than one agent, they all have more than one agent. They can't survive on one agent. Have a duty with respect to training, monitoring, and oversight of their sales force. On all of the examinations I've done in discovery of insurers and MGAs, none has had a fit-for-purpose training, supervision, or oversight. In fact, mostly it's in absence other than promotional sales materials. Let's get, for their continuing education credits, let's get in a salesman who will tell you how to sell more, or bring in a product provider who will tell you why their product's the best thing since sliced bread, but not tell you any of the things about when it's not appropriate, when it's other competitors' products are better. No, that's not education. So the rot begins there. And in the securities industry, dealers and other supervisory officials who are compensated in part by sales have an disabling conflict of interest. It's got to end. Branch manager looking over their sales, they're the people that the advisors they look over. If they're incented by sales, they've got a disabling conflict. Why can that exist? So at some point,
that's a really good
we
point.
got to look at follow the money.
Yeah.
Because that's where most of the problems occur.
The oversight has to not be incentivized in that way, but they always are. They always are incentivized in that way. And back to that, my favorite new quote of the year: mistakes consented by compensation grids. I want to touch on one more thing before we kind of finish up with you giving us maybe one of your most interesting stories. But I'm going to, I have a lot of stuff I repeat on many of the podcasts. This will be one that I do many times. We want to be good at long math, everybody, in the financial advisory space, and not just financial planners, not just wealth advisors, insurance advisors, but realtors, mortgage advisors, and accountants, all of the people. I really believe with all my heart that when you do things, yes, there's a shortcut to get some money now, but if you work out the long math, and there's a reason we were taught to write out the long math, if you do the right thing by your clients, your long math will have you far better compensated, chasing less new clients, getting more warm referrals, all of the things. So give the advice we would give our grandmother is not just this cute little thing to have a little stamp of like hero on our chest. It's actually a lot better for your business and your revenue and your bottom line. Revenue per client, new clients in the door. I'll always believe that, even though it's not always an easy thing to kind of portray for anybody in just one kind of formula that you'd like to make as objectively obvious as it should be to them. But quickly on the segregated funds, for those insurance advisors that want to have that level of involvement to consider themselves a financial advisor, some of them even thankfully, taking it upon themselves to do a little bit of cash flow and budgeting, which most high level professionals don't want to do. They've got a lot of money coaches in the US. Hopefully we'll have some of those in Canada soon. Wink, wink, Sean. But what the other alternative that they have outside of those seg funds, and I remember being pitched seg funds by an insurance advisor that had his CLU that I trusted, and I believe he really believed what he showed me. But there's also the ICPM model where now as an insurance advisor, you're referring off. Now, obviously within that ICPM model, you want to have, and we're going to create a template for that within Finance Village. How do you make sure you're actually continuing to offer the value? Because when I'm referring off, if you're familiar with that ICPM model, Harold, I can refer off to a PM. The PM's going to charge that at the end of the day regardless. They're kind of just taking some of their marketing money and trying to put it back to the insurance advisor for introducing and keeping that long-term relationship. But again, as I've had discussed in other podcasts and with regulators, you want to be able to intelligently convey for the client or for anybody that asks you, well, how are you continuing to work for that beyond the introduction? So how do you feel about that model, and what kind of could you share about your experience with that, and how familiar with it, I guess, are you?
Well, I think there were two parts to your question. I'll deal with the second part first, the ICPM. There's nothing, I'm not at all concerned by the ICPM model in theory. As long as the fees for introduction are reasonable, that the introduction party is still doing valuable oversight, can be communications with the client, then it's a model with, if you're paying a referral fee for somebody sending you an appropriate file that's going to help your client, that's the way business flows. It's not bad. In that itself. What I do like about the model is that it engages people with different specializations. Mm-hmm. So you get more holistic approach. So I like that. You also asked about seg funds at the beginning of your question, and that's a much more complex issue, which rolls down to you're paying higher fees, MERs, mm-hmm. management expense ratios.
I wasn't told that part when I had it explained to me. I was just told the benefit.
So and that's like, you've heard about the a miracle of interest, the compounding value of interest. Well, fees are the inverse. They're the destruction of capital through fees. And reasonable fees are fine, but higher MERs, most seg funds nowadays can be bought, the same sort of holdings can be bought in an ETF at a fraction of the fee. So what you're paying for is an insurance wrapper. And the insurance wrapper has value if your business is likely to go bankrupt, okay? Because then you've got a way of protecting it to some degree from bankruptcy. Or if you want to take a long shot risk and you're got a high risk of dying, because then you've got the death guarantee kicking in. But almost any other situation, the insurance guarantees in a seg fund will not help the investor. They won't. The stats do not exist on how many guarantees have been paid out, but I have never spoke to any advisor who has had experience with a seg fund, and I've spoken to many who have experience with the large area, but where the guarantees have actually been triggered and paid out to a client. I'm sure it's happened. I've yet to hear of once.
Probably
so you're
very
paying
rare
for things you don't need. And it's sold like you're getting extra value from these guarantees. For most people, it's a cost, not a benefit. So seg funds are a concern to me. I'll also give you something else. We also believe that in some cases, the seg fund as presented is not the seg fund as delivered. So we've looked at performance of a S&P seg fund, a mirror of the S&P, and it's a mirror because you don't actually own the underlying product. And when we looked at it, we couldn't understand why the client's performance was so varied from the index. Well, because we looked at the total return of the index, which includes dividends, and the seg fund only paid out on the change of value of the S&P, kept for themselves the dividends.
Lovely.
That was a misrepresentation. It's, I think, a class action, though who wants to take on a class action? They're a mug's game for the lawyer, and they're a mug's game for the client. What you want is fair and truthful products being presented. And so seg funds are a underregulated, high-risk area for the consumer. There are some big changes that have been announced, I think, last week by FSRA and by the Canadian Council of Insurance Regulators as a proposal that will make seg funds much better, but they're not in place right now. So consumers, you're at risk.
Yeah, I won't hold my breath. I'm optimistic, but if history tells me anything, is a lot of times the regulators don't actually implement these proposals. It's all nice, it looks good. I mean, I think about the title reform, and it just became a hogwash of anybody who could buy a title. Now you can call yourself whatever you want. So it's basically back to the original model we had. So I hope it makes a change, but I won't hold my breath. One more question for you before we wrap up. What final advice would you give to advisors to help them stay compliant? For advisors looking to be proactive in staying ahead of the regulatory changes, what key things would you say?
So I want you to look at this like your niece, your nephew, one of your kids, what they're asking you, okay, relative, dad, whoever, I want to get into this. I want to do it the way you've been advocating. Give me the punchline of direct advice. This is the one takeaway I'm going to focus on.
So I'm going to actually do two. Sorry, Sheldon, breaking it into two. One is on your creating a process for yourself that you follow. Repeat it. Be able to say the same thing to clients on some things, like your disclosures, like your relationship with them, like your relationship with your MGA, your insurer, your dealer. Those should be templated disclosures. You should do it the same way every time. You should absolutely keep the best possible records. Keep records of all. Don't use WhatsApp unless it's permitted, because you can't back it up. You can't preserve it all. It can't be overseen. It's probably a breach of your policies and procedure manual with your dealer or MGA. But follow the rules of your MGA and your dealer. Keep records of each step. Know the client absolutely. Show that you've updated that on a regular basis before, more than just asking them, have there been any changes? Work at How's your children doing? How are your relationship with your wife? How's your business doing? Follow up and record it. Make notes. Make notes of your KYP. All about process. Be guarantors of the process, not of the result. So don't
You mean
make
KYC and KYP is not a one-time moment snapshot in time?
No, absolutely not. It's also not a form. That's the
Yes.
tip of the iceberg. Show the rest of the iceberg in your notes. The second thing, which was, how do you stay up on this stuff? Well, LinkedIn has its advantages in this area. Ignore the sales promotional stuff, but there are some great commentators. You mentioned Preet a few moments ago. You mentioned JP, Jason Pereira, excellent source, Dan Hallett, your own websites, not your websites, your LinkedIn postings, and your Finance Village podcast. There are some great materials. Follow me. I try and disseminate information with a short comment so that people are aware and can go to the actual resource and make your own determinations about it. Just because I have an opinion doesn't mean that you have to share it. But take the link, read the link, and make your own decisions. Sign up for releases from FISRA, from Canadian Council of Insurance Regulators, from the OSC, from CIRO. I read them all every day. Look at Investment Executive. That can also be a good source. What you're looking for is things which help you improve your practice, and sometimes future developments help you inform of what you would wish to do today if you knew about it. Because sometimes the discussions about what's going to be in the future are really standards which we should hold ourselves to today. So those are some of the great resources. And from that, you're going to branch out. As I was suggesting earlier, follow the commentators on the LinkedIn threads. Some of them you'll end up wanting to follow as well. And make your own judgments on people who are taking on the tough issues, taking on the issues which challenge you day to day. Don't just read the positive news and don't read the doom scrolling. Read people who are engaged.
Yeah, we are going to concoct a nice list that we're going to put out on the Finance Village LinkedIn, including all the ones that you had there and a few more. Just a very quick version before you go. Tell us a quick blurb about a crazy case that you've had, or a crazy victory, or the most interesting or blasphemous thing that you've seen.
There are many tales, and they're great tales, for cocktail parties. Let me give you an example of a financial advisor who joins a team and believes new insights, has new technology, sees the next new things. Turns out mostly what they're doing is complex option trading, selling private equity when the option trading gets shut down by the dealer, and momentum trading. None of it suitable. None of it being disclosed as high risk advice from a guy who's practically a newbie. The dealer is aware of it. They're putting them under supervision, enhanced supervision, close supervision. They end up reporting them. But in the meantime, the clients are at risk. They never bother to warn the client. They never bother to check, even when they catch the advisor in lies or lacking notes, to see whether the clients sign on. And when on 2 cases, a complaint came in and they intervened, the records show what they were doing was trying to get the client to admit to things the client didn't understand. So admit to allowing discretionary trading in a non-discretionary account when they didn't know the rules that made it illegal, a breach of the rule to do that very activity. This is some of what's going on by some of the larger dealers in Canada. They exist today, and it all comes back to complaint handling. If CIRO was serious, they would do a sweep of complaint handling look at the underlying files and see what has not been reported to CIRO in a timely basis, and what is being breaches of the complaint handling rules and undermining the reputation of good financial advisors, of good dealers, of the industry. It is rot that comes from, frankly, a failure of a compliance culture. It starts at the top and trickles right down to the branch manager, and then, I'm going to use the term this time, the salesperson, because that's what they seem to be, pitching lottery tickets.
Well, you've given me a good few tidbits to kind of summarize and wrap up here. So it always does come down to the individual. You can be in an MLM, you can be in a bank, you got to hit the ceiling of what's the best you're able to do, and then figure out how you get rid of that ceiling as soon as possible, whether it's moving your foundation to another spot, surrounding yourself with better peers and individuals you can run stuff past, but get rid of that ceiling as soon as possible. And for those that should be holding us on the front line accountable, maybe we need to get to more interesting things than the fines. When I was in grade 12 and my grandparents, and I lived in a little village, and there was a town 20 minutes over, and they had this big concert for Steppenwolf and Lynyrd Skynyrd and Led Zeppelin. Everybody was going to go. We never get concerts, so it was in the next province. And all I had to do to win those tickets was put on my grandfather's Speedos, douse my body in Vaseline, and stand on the Trans-Canada Highway for 5 minutes while I was flexing to the commentary from the radio guy. Maybe we should put up a sign about, in that same scenario, some Speedos, some Vaseline, and I did not oversee properly the advisors under my compliance. And maybe we need to get a little bit more public about those things.
Then let me throw in a last comment. I'll just anchor to something I said earlier, which is financial advisors are more important to most Canadians than their other professionals. This is an honorable profession. You can make a difference. And what you have to do is keep up on the rules, make sure that you put your client's best interest first and foremost, recognize your own conflicts, disclose them, and follow process. The last thing is, and then make records. So if there is a complaint that's unwarranted, you can defend yourself because you can explain what you did, when you did it, and how you did it.
Yeah.
You
And
guys
thank you
are
for
too
highlighting
important
that part,
not
Harold.
to take care of your own book of business.
I appreciate you highlighting that, because I do want people to see that as they're not just looking at a career, they're looking at something that's such a great opportunity if you're doing it the right way, to wake up motivated, to wake up feeling like you're making a contribution, to have job satisfaction, to make a huge impact on people's lives. I love that you highlighted kind of that spending, then the guaranteed rate of return of managing debt. And then, as Mark McGrath, who I'm sure you're familiar with as well, would say, typically is, what is your savings rate? What is your rate of savings? So I'm just going to quickly ask you, these are just quick questions. Since you mentioned this about your 10-year-old car, so you must know then, what is the best kind of car to drive?
One that you've paid for.
Thank you.
Got it.
The only
Bingo.
person that's ever answered that. They always think I'm talking about a style. You're the only one that's ever got it right, because the number one wealth killer of all the cool dudes of $800 to $1,200 a month that they can't afford is the car payment. The best kind of car to buy is the one that is fully paid off, that you can pay for in cash. So I want you to know, Harold, while it may feel sometimes in a lot of the circles that you're in and the things that you have to feel like in these regulatory bodies that you are a NAD fly of sorts, I want you to know that you are seen, you are heard, you are appreciated by myself and a lot of people that I know that respect you. Usually we have conversations about you. You are a maverick. You are as charming and dazzling as that LinkedIn picture is that you have that makes you look like you got a Hollywood headshot. I would take a picture of you in spandex in a superhero suit and put it on my wall. Not to see you in spandex, but because I see you, I really, my heart has been, I didn't want to stay in finance. I come from 10 generations of fishermen. I'm the first one with front teeth. And I want to bring a huge heart into finance. And as someone with that kind of life intent where I feel obligated to stay in here, I really appreciate what you've done. And I would like your permission, if we ever get the science behind it, that perhaps we could clone you, because we certainly don't have enough of you in Canada. And, as a conclusion, that misleading financial advice doesn't just harm clients, it harms trust in the entire ecosystem. And not just, you can be the guy, but your kids, your spouse, your family members, your friends, they're going to hear the stories. It may not be about you. You may slide yours through, but there will become the underlying mistrust that harms people's engaging in finance entirely. And by combining strong regulatory oversight, informed clients, and collaborative efforts, thank you so much for highlighting now is the time for the collaborative efforts. We can build a system that works for everyone and that can make my grandmother proud and be a place where my daughter will be able to navigate finance safely and successfully without having to have a bulldog, father that will come and, rip a new hole at the bank's friendly side there when I'm not around. And we're very, very grateful, not just for what you do in the industry, but for taking any time with us today. We're all working hard to get our time back for our families, and that you've given us any time for our podcast today. We're extremely grateful.
Appreciate it.
Thank you. Keep up the great work. Look forward to your next steps.
Yes. And
awesome.
We will be looking to have another chat with you someday.
We'll be in touch.
Okay, thanks, Harold.
Thanks, Harold.
92% of people trust referrals from people they know. But there's a better way to make those introductions. Wrap your arms around your client with your professional team. Join your client's team free today. PocketFinance.com.